When the Fed cuts, but the bond market says no. A structured narrative essay. Section 1, The Cut That Didn't Ease. It begins the way these stories always do, with a rate cut meant to calm the system. In late 2025, the Federal Reserve lowers its overnight rate, bringing the federal funds range down toward the mid 3% area. The language is careful. Inflation has cooled from its highs. Growth is slowing. The economy, the Fed suggests, needs a little relief. But something doesn't respond the way it's supposed to. The 10-year Treasury yield doesn't fall, it rises. The 20-year and 30-year follow. Mortgage rates remain stuck near 7%. Financial conditions tighten, not loosen. Markets hear the cut, but they don't believe it. This is the moment where the story departs from the textbook and enters a different genre entirely. Section 2, Two Lenders, Two Time Horizons. To understand what's happening, you have to understand who is actually lending to the economy. The Federal Reserve lends overnight. It sets the price of reserves between banks. Its power is real, but short-dated. Bondholders lend over decades. They finance deficits, mortgages, infrastructure, and governments themselves. They care about one thing above all others: whether the purchasing power they get back will be worth what they give up today. In normal times, these two lenders move together. In abnormal times, they don't. What makes this period abnormal isn't the rate cut itself, it's the backdrop against which it occurs. Section 3, The Weight of the Balance Sheet. By 2025, the United States is running annual deficits approaching $2 trillion. Treasury issuance is relentless. Debt is no longer a cyclical phenomenon, it's structural. Japan, thousands of miles away, is living an even more extreme version of the same story. With debt exceeding 230% of gross domestic product, the Japanese government passes a 21.3 trillion yen stimulus package, roughly $135 billion, explicitly designed to soften the cost of living squeeze caused by inflation that refuses to go away. Inflation in Japan is no longer a theoretical threat. Core consumer price inflation sits around 3%, well above the Bank of Japan's 2% target. In the United States, inflation has cooled but remains sticky enough that markets question whether victory has truly been declared. This is the environment in which policy is being made. Section 4, The Market's Quiet Rebuttal. Bond markets don't issue press conferences. They respond in price. In the United States, even as the Fed signals one cautious cut in 2026 and markets optimistically price in more, the 10-year yield drifts upward toward the mid 4% range. Bank of America and others forecast it climbing toward 4.5% despite easing expectations. In Japan, the message is even louder. The 10-year Japanese government bond climbs past 2%, an 18 to 20-year high. The 20-year approaches 3%, levels last seen in the late 1990s. The 30-year hits record highs above 3.4%. This is happening after decades of yield curve control. After years of being told bond vigilantes were extinct, they weren't extinct. They were waiting. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Section 5, The Return of Term Premium. For much of the post-2008 world, investors accepted something unusual: little to no compensation for holding long-dated government debt. Term premium, the extra yield demanded for inflation and duration risk, was suppressed, sometimes negative. That era is ending. By late 2025, term premium in the United States has reappeared, moving towards 60 to 70 basis points. In Japan, the yield curve steepens sharply as investors reassess what decades of debt and renewed inflation actually mean. This isn't panic, it's repricing. Bondholders are not predicting runaway inflation tomorrow. They are pricing the risk that inflation control is no longer politically or fiscally cheap. Evidence and forward-looking signals of market enforcement under fiscal dominance. Let me explain what this table is showing and why it's important. What you're looking at here is not a forecast in the traditional sense. It's a diagnostic framework. It shows a set of signals that consistently appear when markets stop deferring to central banks and start enforcing discipline themselves. In other words, it tells us when we've moved from a world of monetary control into a world of market control. Let's go row by row. At the top, we start with central bank behavior. The pattern here is hesitation. In the United States, the Federal Reserve is pausing or cutting cautiously, even though inflation risks haven't fully disappeared. Internally, there are divisions. Externally, the language is wait and see. In Japan, the central bank is normalizing only gradually, deliberately avoiding aggressive tightening because of political and fiscal constraints. The key point is this: policy is constrained before inflation is fully resolved. Next, look at long-term yields. Despite that caution or easing at the short end, long-term yields are rising anyway. In the U.S., the 10-year Treasury is projected to move toward roughly 4.5%, even as markets expect rate cuts. In Japan, the 10-year government bond has already pushed above 2%, a level not seen in decades, with longer maturities rising even more. This tells us the bond market is not taking its cue from central bank policy, it's setting its own price. That leads directly to the next row, the return of term premium. For years, investors accepted very little compensation for holding long-term government debt. That has changed. Term premium has reappeared in the U.S., and the Japanese yield curve has steepened. This reflects renewed concern about inflation, about debt sustainability, and about the risks of lending long-term in a high-debt world. This is not fear. It's rational repricing. Now look at currency behavior, especially Japan. Despite rate hikes, the yen continues to weaken, trading well above 150 yen per dollar. That tells us fiscal stimulus, debt scale, and inflation risk matter more than incremental policy moves. Japan is important here because it serves as a warning case. If currency credibility can weaken there, it can weaken anywhere. The next row captures market enforcement, sometimes called bond vigilantes. This is where markets actively impose discipline. Investors demand higher yields to compensate for risk, effectively rejecting transitory inflation narratives. This mirrors past episodes like the 1970s, when markets forced policymakers to confront reality rather than manage perception. Then we see the real-world transmission mechanism: mortgage rates. In the U.S., 30-year mortgage rates have moved towards 7% or higher, even as the Fed pauses or cuts. That directly affects housing, consumer behavior, and credit formation. This is how bond market decisions show up in the real economy. Next is financial conditions overall. Higher long-term yields offset any easing at the short end. Credit spreads widen. Borrowing costs rise. Financial conditions tighten, even though policy is technically accommodative. In Japan, fiscal stimulus collides with rising bond yields, creating the same tension through a different channel. Then we get to credibility. Persistent divergence between policy signals and market pricing tells us investors are skeptical. In the U.S., this shows up as hawkish cuts. In Japan, it shows up as continued currency weakness. The longer inflation remains sticky, the greater the credibility erosion becomes. Finally, the last row ties everything together. Policy becomes reactive rather than proactive. Instead of leading markets with forward guidance, central banks respond to market stress after it appears. Yield spikes, currency moves, and tightening conditions force adjustments. Policy follows pricing, not the other way around. So taken together, this table is telling a single story. When deficits are large and debt is heavy, central banks may still control short-term rates, but they no longer control outcomes. Long-term investors do. Rising yields, tighter financial conditions, and currency pressure are not accidents. They are enforcement mechanisms. This table isn't predicting a crisis. It's showing you the rules of the regime we're operating in. And once you recognize the pattern, you stop being surprised by the outcomes. Section 6. The currency tells the truth faster. Currencies are often the first to flinch. Despite rate hikes, the yen weakens, sliding toward 155 to 157 per dollar. The message is blunt. Fiscal stimulus, debt scale, and inflation risk matter more than incremental policy tightening. The yen becomes the warning label. If even Japan, home of domestic savers, institutional buyers, and decades of central bank intervention, cannot fully anchor its currency while yields rise, no advanced economy should assume immunity. Section 7. Enforcement without permission. Here's the critical turn in the story. Despite rate cuts and pauses, mortgage rates rise, credit tightens, housing stalls, financial conditions worsen. In the United States, 30-year mortgage rates move toward or above 7% as Treasury yields climb. In Japan, borrowing costs rise quietly but steadily. In both cases, policy intent is overridden by market pricing. This is not a failure of central banks. It is a constraint imposed by scale. The market is enforcing discipline without asking for approval. Section 8, a pattern, not an accident. None of this is new. The 1940s saw yield pegs collapse under inflation pressure, forcing the 1951 Treasury Fed Accord. The 1960s and 70s saw political pressure to keep rates low and in double-digit inflation, and a brutal reset under Volcker. The early 2020s saw transitory narratives dissolve as break-evens and yields rose first, policy followed later. The pattern is consistent. When fiscal demands dominate, credibility migrates from policy statements to market prices. Section 9. Why the bond market always wins. Central banks control the supply of money. They do not control the time value of trust. Bondholders lend across decades. Inflation compounds. Credibility erodes slowly, then all at once. When belief breaks, yields rise, not because markets are rebellious, but because capital demands protection. The bond market doesn't need to be right every day. It only needs to be right over time, and time is its advantage. Section 10, the verdict. When the Fed cuts, but the bond market says no, it isn't confusion. It's a verdict. Short-term rates are policy. Long-term rates are belief. In an era of fiscal dominance, central banks can still act, but they can no longer dictate outcomes. Markets price the future, whether policy is ready or not. Credibility is not announced, it is earned. And when it's questioned, the bond market is the one that keeps score.